Hi, everyone, and welcome to our first quarter 2024 market update presented to you by Tobias Financial Advisors. We're excited to be here on April 16th, 2024. Hopefully, our clients and those listening today have now squared up with Uncle Sam by making those tax payments and now are ready to learn more about investments. So, without further ado, let's get into the presentation today. A little bit of housekeeping to start. Everything here today is more general in nature. It's more to be informative, to keep everyone abreast of what's happening in the financial markets. If you do have a specific question about your portfolio and how that may affect your long-term financial goals, please give us a call here at Tobias Financial Advisors, and we're happy to assist you to review your unique situation. In our webinar technology today, if you do have a question, please put it into the questions area, and we will do our best to address those at the end of the presentation. And there's also an ability to download the slides that we're going to be sharing today. So if you want to save those and review those and look at them later, that's more than welcome. Please download the slides to your desktop. A little bit more about Tobias Financial Advisors. We have been in business 44 years, and we're managing over $700 million for over 300 families. We really put the importance of education, not only for ourselves, but for our clients. So we want to really be informative. We believe in being a certified financial planner, and our team has been growing over the past many years, and we're always looking to do what's best for the clients and meet more folks who might need our help. So if you think of an introduction to our firm, please let us know. We'll be happy to be introduced to those loved ones or those colleagues that may need some financial planning support. On the bottom right here of our picture here, we just got done with the Fort Lauderdale corporate run. It was a really fun night, and we had great participation amongst our team. Speaking of team, we have two of our panelists here today. We have Chad and Franco, and let them introduce themselves.
Good morning. I guess good afternoon. It's 12:30 now. My name is Chad Neesmith. I'm portfolio manager at Tobias Financial Advisors. I've been here just about 3 years. I'm more of a little bit behind the scenes. I do some trading and research and meet with some clients, but overall, I love it here and happy to be with you guys today and happy to talk about the markets.
Good afternoon, everybody. My name is Franklin Gay, but most everybody knows me by Franco. I'm a wealth advisor here at Tobias Financial, and I've been with the firm about 4 years. So looking forward to speaking with you about some new provisions that have come about through the Secure Act 2.0. So looking forward to it.
And thanks for joining. And my name is Matt Sainholtz. I'm the Chief Investment Officer here at Tobias Financial Advisors. I've been with the firm for over 15 years, a co-owner of the firm, and really helped put together the investment philosophy and what we're doing here at Tobias Financial Advisors as far as making our clients' money grow. A little bit about our philosophy. We really believe in managing money for a purpose. There's no better way to think about what you're trying to achieve with your assets in your portfolio, and then starting with that goal, and then building the building blocks and using the portfolio as a means to meet those goals and help your family achieve those dreams. So we start off and develop a risk tolerance, figuring out what you need from the portfolio to come up with an investment plan. And then once we have a long-term investment plan, we develop a portfolio by choosing between various asset classes, whether that be stocks, bonds, real estate, and some of the pure tenets of our approach are that we want to diversify, we want to keep costs low, and we are kind of born out of a accounting firm here, so we want to make sure that we're minimizing taxes and making sure that we're doing our best for the best after-tax returns that we can achieve. Today's agenda, we're going to be tackling, what happened in the first quarter as far as the markets and performance. How does that kind of fit in with the overall long-term performance, and just kind of do a review of what we've been seeing out in the marketplace. Chad will be diving into some more economic updates and giving us a brief overview of the mega cap sector here in the United States. And then Franco will be chatting about educational planning and 529 college planning. This is some new things that are happening in regards to new legislation that we all want to make sure everyone's aware of, that we think could be really powerful for some of our clients. We want to make sure we're highlighting that as we move through. So what happened in the first quarter? Very strong. The rally in 2023 continued throughout the U.S. stock market and the globe, really, and the stock markets around the world. The U.S. was up another 10% in just the first quarter alone. Very, very strong. Really, economy still going. We have jobs still strong and low inflation. And so we really saw some positive returns here in the U.S. Developed international countries such as companies in Japan, Germany, also seeing gains. The couple of red arrows here based upon the last quarter, bonds, fixed income or bonds were down slightly. This is due to the fact that rates have gone up since the beginning of the year. At the beginning of the year, the 10-year bond here in the United States is trading around 4.05%. And today it's north of about 4.6 today, last I looked. So a little bit of higher interest rates brings down the returns on the bonds, but overall a continuation of a strong economy and a strong stock market during the first quarter. And you can see on the U.S. stock market will just stay there. An average return dating back to 2001 is 2.4. So we were 4 times the average return here in the U.S. Looking at the long-term returns, 1 year in the U.S. stock market, as you can see, very strong over the last 12 months, dating last March 2023 to now, March 2024, 29% increase in the U.S. stock market. And all we like to see here is green arrows up. So makes our job a little bit easier when the markets are cooperating. We'll dive into a little bit more of the details of why we're seeing some of these increases in the various markets across the globe. But I think just to point out here is that the long-term markets usually work themselves out. So when there are corrections or downturns or tough days that we get a lot of clients seeing 500 points down in the stock market today. Well, yeah, that does happen from time to time, and geopolitical events that have occurred recently are scary. But when markets average out and digest information over the long term, it does become a very positive outlook for investing in risk assets. So this is a chart of asset class returns in the first quarter. It's kind of interesting to note that Japan was up about 10.65. The U.S. was up over 10%. So some countries some developed countries, the United States, Japan, Germany, France, actually all hit record highs in their respective stock markets in the first quarter of 2023. So again, just been a really strong period over the last 12 months in the stock markets and in the equity markets. And Chad will dive a little bit more into what's happening there as far as the economy and some of the stock markets themselves. On the downside, China has been down again. They've been experiencing a kind of subdued economic growth for the past couple of years now. So they haven't had the growth that we've seen here in the United States. So, but the valuations in those stock markets are still pretty attractive, and so we're not giving up on kind of our global perspective in investing. Interesting chart here, wrapping up the performance for the first quarter. So as I said, 10% in the U.S. stock market, that's about 4 times the average over the last 20 years or so. And that ranks as the 15th best year for the U.S. stock markets as a start, dating back to 1926. And so what we're showing here is what the performance was historically on on these top years, and then over the next 9 months. Okay, what does that actually translate to? If there's a pattern or an average, of course, no past can accurately predict the future in investment returns. But we've seen that when years start off pretty strongly, on average, they're positive for the next 9 months, and only 2 times out of the 15 top years were they a negative returns, and that was back in 1987 and 1930. And so this has, it's been very positive, a lot of positive sentiment out there in the economy and in the stock markets and in people's portfolios. And so I'm going to turn it over to Chad so he can kind of go through what we're seeing in the economy and why the stock market continues to grow over the last 12 months.
Thanks, Matt. I really appreciate it. We'll start off with a little bit of an economic update. Always my favorite topic to talk about is inflation. As you can see, this chart goes back to May of 2022 when we had like a whole nother picture of inflation over that time period. The summer of 22, you may recall yourself pulling up to a gas station and looking at $5 gasoline and going, oh my gosh, what is going on with this economy? Also, if you were to buy a mattress in goods, you know, or a toaster or something like that, like we saw inflation in goods, we saw inflation in oil, we saw inflation in food and egg prices. Remember, those were, I think, $7 or $8 for a dozen eggs at one point. I mean, it was a whole nother world, it seemed. But as time moved on, we saw inflation kind of cool down. And in May of 2023, gas prices started coming down. Those core goods inflation actually came down to 0. And we went from a picture of a 9.1% inflation all the way at the top, now at the low 3s. We've been at the low 3s for the last 6 months now at this point. But it's a different type of inflation that we're seeing. It went from gas and goods and food to more shelter and car insurance. As you can see, shelter makes up about a third of inflation right now, and it's trending at about 6% growth year over year. So if you're thinking about renting an apartment or applying for a mortgage, any cost of living is trending at about 6% inflation. And it did peak a few months ago at about 8%, but has been coming down. It's just a little bit slower to get down to like our 3% target that we're looking at. Also, car insurance. So car insurance is lagging a little bit. Car prices went up a lot in 2021 and 2022, and the insurance companies are trying to catch up to that. The new and higher car prices that we're seeing now, it costs a lot more to insure a $40,000 car than it does to insure a $30,000 car. And so people are re-upping their insurance premiums and seeing 20% year-over-year growth in car insurance. And so it's a little bit of a sticker shock to consumers, but overall consumers are still spending. Yesterday, we got really good retail sales data, up about 1.1% over a month. We were only expecting about a 0.5% growth in retail sales. So consumers are still spending and they're still buying things in the face of higher prices. And that's supporting the economy. GDP, that retail sales data revised GDP growth up from about 2.4% to about 2.8%, just that one report. And so right now, the economy is holding strong. We just added 300,000 jobs last month. And people are still looking for jobs, and people are still getting jobs. So overall, the economy is strong, and inflation is trending down. It's just going to take a little bit of time to get down to what the Fed thinks is proper, which is around a 2% inflation target. And it doesn't really have to do with supply and demand issues right now. It just has to do with these lagging factors primarily that we're seeing in housing supply and in car insurance. Those are the two main factors. So hopefully we can get out and start building houses in the world and give some more supply to people that want to buy homes. And maybe interest rates will behave in the road whenever people apply for mortgages. But overall, that's the inflation picture, and it transitions really well into our interest rate outlook and how we see interest rates moving this year. So move to the next slide, Matt.
Sure, but Chad, before we do it, on the auto insurance, I mean, I opened up my envelope and yes, it was up 20-25% recently. Unbelievable. We kind of, not that you can predict the future, but like, the auto insurance, that's not really expected to continue?
No, we're not expecting runaway inflation. This is something that's just kind of peaking right now, and we're thinking that it'll trend down over time. And so we saw the recent print of 3.5% on the back of a high consumer spending. That's just like a one little uptick in inflation that we've seen, but we're not expecting like 9% inflation over the course of over the next year or anything like that. If anything, we're going to see inflation trend downwards, and including the auto insurance premiums. Great question, Matt. I really appreciate it. Inflation translates into interest rates because the Federal Reserve is trying to figure out how tight or how easy they want to go with interest rates. And right now we're at about a 5.4% federal funds rate, which is historically what's called a tight rate, meaning that rates are high, it costs more to borrow money, and it slows the economy, or at least it tries to put a little bit of brakes on an economy that's roaring at 2.8% that we're seeing right now. And we're going to see, as we think, inflation is going to start to fall, meaning that the Federal Reserve doesn't need to keep interest rates as high as they have right now. And they're going to look to maybe loosen and drop interest rates. Going into the year, the market was pricing in 6 interest rate cuts, meaning that this number would go down about 1.5% over the course of the year. But we've gotten really good economic data. We've gotten good jobs reports, as I talked about. And now the Federal Reserve and the market are kind of in line. We're expecting 3 cuts or about 0.75% to end the year. So so short-term money markets, CDs that are now yielding a little bit over 5. We can kind of look for them in the high 4s towards the end of the year. At least that's how we're trending right now. But overall, we're at peak interest rates. We don't expect interest rates to trend higher. If anything, they would just be at this rate for a longer period of time before they fall. But yeah, overall, that is just our economic update in general, like what's going on in the economy. The economy's good, demand is strong, and right now, economic data is pointing to higher GDP growth and falling inflation, and really trying to shake out the last little bit of our COVID economy that we went through a few years ago. I want to transition and talk a little bit about the markets and just a particular topic that's on our minds, and just to think about how stock investing and how you can just wrap your head around the market and what makes up the market. So on the right side, top right of your screen, we're looking at the top 10 stocks of the S&P 500. And the S&P 500 is seen as the large cap domestic index. It doesn't include any international names, doesn't include any small cap stocks. It's just the top 500 largest 500 companies in the United States. And as you can see right now, it's taking up over, those top 10 names are taking up over 1/3 of that index if you were to measure it as a market cap. So, these stocks are Amazon, Apple, Microsoft, Tesla, ExxonMobil, Berkshire Hathaway, just to give you some examples, NVIDIA. And it's really come up a lot. If you were just to go back to the 2015, 2016 era, you can see from the top right that these were under 20% of the top 500 names. And now they've gotten to be really concentrated, and they're starting to drive investment returns within the S&P 500. Those individual company performance are really starting to magnify the returns of the overall large cap market. And so overall, we just want to be more conscious of that concentration risk and that business risk within those top few names of the market, and how it drives long-term investment performance. But if you were to look down at the bottom right of your screen, you can see this is just the top holding of the S&P 500 going back to 1980. And you can see that these names change. They fluctuate. Going back to 1985, it was IBM. IBM's building computers. They were seen as something priced to grow and to take on the next generation of personal computing in the economy. And then we go over to the top .com, where Microsoft took almost 5% of the S&P 500 in 1999. One thing that was interesting about Microsoft in 1999 is it was priced to grow, as you may recall, the .com bubble. So it was priced to grow very fast. I think you were paying 80 times earnings. So for every $1 of earning, you were paying $80 for Microsoft stock. And Microsoft did grow. It grew at about a 14% rate of return in earnings. So they grew their earnings from 1999 to 2011 by 14%. But in 1999, it was priced so highly that you still lost 50% of your money if you were to buy a Microsoft stock in 1999. So it's not that a company would grow, it's how much will a company grow to get your investment return. And we'll see a little bit later on how price to earnings works, and how much you're paying for stock is a really large part of the equation. Just moving on to 2008, ExxonMobil, when gas prices were really high in 2008, they were 5% of the index. Apple now is 7.5% of the index of the S&P 500. So it's just to illustrate that the top name changes over time, and you want to be conscious of your investment in those top 10 names, because if you were wanting to own the up and coming stock, you want to maybe tilt more to a small cap, and that's one of the many reasons that we really harp on diversified portfolios, including international companies, including emerging markets, including small cap stocks in your portfolio, and not just seeing your equity position as the S&P 500 or what's becoming more and more just these 10 stocks that really could drive returns. So for an example, for driving returns, this year NVIDIA is up about 75%. They're responsible for about 2.25% of return of the S&P 500 just year to date. And as of yesterday, the S&P is up about 6 and change. So NVIDIA is driving 1/3 of your investment return. So when you think about financial planning and a long-term financial plan, it's difficult to predict your investment returns or to plan on how you're going to retire when if this demand for these chips doesn't work out, then I won't be able to retire. You know, we don't want that. We don't want to place your whole retirement picture on just a few companies. And if Tesla's going to have enough demand for their electric vehicles, it's not something that we really want to take bets on. We like consistent returns in portfolios, and that's how we position our portfolios, is just to be more of a consistent return rather than getting behind the exciting trend at the time. I'm going to move on to the next company, unless Matt or Franco want to have any comments about this on this previous slide, but a little bit more on those top 10 names. On the right side of your screen, you can see what's called the price earnings ratio, is what I talked about last slide. The top 10 names going back to the .com, you can see in the green, they were priced at 44, 45 times earnings. That's the Microsofts. That's the AOL Time Warners. That's the those old 1999 stocks that we remember. And you can see the .com bubble kind of like fizzled out, maybe more than fizzled out. It burst. And we saw a long period of time from 2004, 2005, where all the way up to 2015, 2016, where those top 10 names were priced pretty much evenly with the rest of the S&P 500. And now, over the last 8 years or so, we've seen a re-acceleration of that, where there's a lot of excitement around artificial intelligence, a lot of excitement around technology, and these companies are priced at a little bit over 50% of the rest of the stock market right now, meaning that on a per earnings basis. So if you were to buy $1 of earnings in some of these top 10 names, compared to $1 of earnings with the rest of the S&P, those bottom 490 names, you're paying about 50% more in today's earnings. So it means that these are priced to grow faster. And it's not saying that we think that a lot of these companies are good companies and we think that they're going to grow. The question is just how much are they going to grow, and what does that mean for your overall portfolio? But overall, we don't think that these small number of names should drive your investment return or be a primary reason that you make or break your retirement number. And again, we just really focus on consistent returns in portfolios. And that's what we're saying, is we're not saying don't own these names. We're just saying be conscious of your concentration within these names and how it affects your returns, but also, more importantly, your consistency of returns in your portfolio and the long-term return.
Yeah, we've seen current clients and potential clients come in with some of these tech names, these stocks, and they just dominate their overall portfolio. So we're able to do techniques to help mitigate some of those risks, potentially by something called direct indexing, or by just kind of maybe using stock option strategy. What we just overall, it's our bread and butter to invest in. We have to remain diversified. And so this picture here, as Chad pointed out very clearly, that we want to just continue to be diversified and make sure that we're not just overly focused on those top 10 stocks that are carrying the market at this time. Thank you, Chad.
Yeah, thank you. I think we're going to go now over to Franco for the 529 discussion.
All right. Thank you so much, Chad. So today we're going to talk a little bit about 529 plans and some of the changes that have been made to them since the Secure Act 2.0. So we all know that college is super expensive. In fact, it's one of the largest expenses for households, next to house purchases and car purchases. And I think this graph does a really, really great job of illustrating that for us. So on the left-hand side here, what you see, that smallest bar is for public in-state tuition for a college student that's age 18. So that's right now. And you can see that that's $103,572. You have public out of state as the next bar there. That's $180,680. And then $242,186 are the private costs that you can expect. And that's today, right? So very expensive. And going over to the far right side, we can see the compounding effects of education inflation. So if we have a newborn today, right, we can expect them over their 4-year tenure at college to pay for public in-state $249,000, public out-of-state $434,000, and private, 582,000. So just massive costs, right? So what can we do to help mitigate this and to help plan for this? If we go to the next slide, we'll talk a little bit more about that. Okay, so the 529 plan is going to be a great tool to help mitigate this. So basically, you are investing in an account that leverages the market, leverages the time value of money, investing those funds, letting them grow tax deferred, and then making qualified tax-free distributions for education expenses. Now, for those of you that want a deeper dive on 529 plans, our CEO, Marianella Collado, gave an excellent presentation, which you can find on our website by searching 529 plans and other college savings options. But it's basically, as I mentioned, right? Investing the contributions and then getting that tax deferred growth and then using the distributions tax-free. So the idea here is to start investing as early as possible so that that 529 balance can grow and you can let that market growth offset some or all of the costs that we discussed in the previous slide. Now, you'll need to take a look at what the costs are that you want to reimburse or that you want to pay directly from the 529 plan, as they're wide ranging. So they can include tuition, room and board, books and supplies, computers, apprenticeships, and even education loan payments, special needs services, and K through 12 tuition. Now, in some states, you can even receive a state tax deduction for this, but you want to check on each state's rules on what constitutes a qualified education expense when you make the distributions to ensure that you don't run afoul of these state tax laws and thus forfeit your deferral or tax benefit that you had in prior years. So we talked about the education costs and we talked about the 529 plans and what you can spend the funds on. There is a sentiment among some folks that what if I put too much money into the 529 plan, right? Well, you have options and you've had options prior to Secure Act 2.0. Those options were to change the account beneficiary to another eligible family member, and the IRS conveniently lists out who is eligible, or you can withdraw the amounts and suffer a 10% penalty on the earnings in addition to the regular tax, right? So maybe you don't like those two options. This is where the Secure Act 2.0 provision gives us some extra wiggle room. So now in 2024, you can roll over 529 funds to beneficiaries' Roth IRA accounts. And this is incredible because it provides a head start to those beneficiaries' retirement plans while also making the consequences of overfunding a 529 plan less worrisome, right? We know that we can make that money work for ourselves, or rather our beneficiaries, in different ways. So you want to be careful with this. This is brand new Secure Act 2.0, and so the IRS is still issuing guidance on this, but the rules that apply here to ensure that you're able to take advantage of this opportunity are as follows. So first, the Roth IRA must be in the same name as the 529 beneficiary. That beneficiary must also have earned income equal to or exceeding the amount of the rollover. The max rollover per beneficiary is $7,000 per year, $8,000 for those over age 50. There's a lifetime maximum rollover per beneficiary of $35,000. 529 plan must have been open for at least 15 years. The rollover can't include 529 contributions or investment earnings made in the last 5 years. And finally, and this one I think is a really, really great thing for planning opportunities, there are no phase-out limits, which means that individuals who may normally have been phased out due to their high income from a regular Roth IRA, I think for married filing jointly in 2023, 2024 was $228,000, they can make these rollover contributions without taking their high income into account. So it presents a really great opportunity for those clients or even the beneficiaries, right? Kids, grandkids who make an exceedingly high income over those income phase outs. So one caveat here is that this is all true from a federal perspective, but you want to consult with your financial or tax advisor to discuss what this looks like at the individual state level, because each of these states have their own rules on how they're going to treat these rollovers. So I think that this is a really, really great strategy and something I'm really looking forward to implementing with my clients who have residual funds in the 529 plan from students who didn't use all of them. Maybe the students got scholarships or other kinds of assistance. And so we need to figure out what are we going to do with these funds. But until then, looking forward to talking to you all again at a later time, and I'll pass it back over to Chad.
Franco, thanks for giving us the 529 update. A little sticker shock from your first slide, thinking about my 1-year-old going to college and how much it costs in 18 years. I'm like, oh gosh, but that's okay. I can start planning today. Yeah, start saving. I've got the 529 open. I just got to get those, bump up the deposits, the recurring deposits into them with this. So I'm going to close out a little bit with a few more slides about positioning and just things to be cautious about and things to be optimistic about, just to close things out. Just a little bit about portfolio positioning. Our fixed income are neutral on duration, meaning that we do like to have a little bit of a duration in our portfolios, meaning interest rate sensitivity. So as a bond, when interest rate goes up, bond prices generally go down, and when interest rates go down, bond prices generally go up. And that historically has been a good hedge for stock and equity, those portions of your portfolio. So we're just trying to stay neutral there, just as a good hedge should we roll into recession over the next several years. But we're also keeping bonds high quality. We do not think we're getting paid to take any kind of credit risk to buy bonds that are of companies that may file for bankruptcy in the next several years. We think the Federal Reserve is being really tight on interest rates, and those companies could potentially struggle as they go and request like refinancing. So as those loans mature, they need to go out into the market and try to borrow more money, but rates are higher now, so it may be a little more difficult for those companies to do so. So we like treasuries, we like high quality corporates, we like mortgage loans, high quality. On the stock side, we're maintaining our international exposure. We think that international stocks they offer a nice discount to domestic U.S. stocks. So for right now, if you were to buy domestic companies, it's about 50% more on a per dollar of earnings basis. And so we like the diversification benefits of holding international stocks within the portfolio for that reason, and also with the concentration reason we covered previously in this presentation. New and exciting, we have a new manager within our emerging markets. We can't mention them by name or give any specific investment advice on this webinar, but we're very happy about the new manager in emerging markets. We think that he'll drive performance within that space, and we're working them into the portfolios right now, actually. So really excited about that. And on the opportunistic side, we still have preferred stock for the yield. We're getting a little bit over 6% yield on preferred stocks right now. And that short-term cash position in floating rate treasury is still yielding a little bit over 5%. So nice defensive investments right now for where we are in the stage of the economy. The Federal Reserve is being tight. We're in generally what would be called a late stage economic environment, and having those positions and taking that small amount of risk for a 5 or 6% return, we think is really good right now. So those are our general portfolio positioning thoughts. I think we're gonna move on to just optimistic, just closing out. What are some things we can be happy about? We do think we're at peak interest rates. Historically, this is a good time for investors. Generally, when rates fall, other asset classes do well. It's kind of like the opposite story of what we saw in 2022 when rates went up really fast and 96% of asset classes were down. Historically, the opposite effect happens whenever interest rates fall. Labor market, meaning jobs, continue to be strong. As we spoke earlier, 300,000 jobs were added last month. The economy is still adding jobs. We're not losing any jobs. Immigration is, people are coming into the country and looking for jobs, and is driving GDP, and that's what we're seeing flow through in the economic data right now. And then again, stock market valuations in the international space are really attractive historically and currently to today. So we do think that's something to be optimistic about. Let's go to the next slide. Just some things to think about, some cautionary things. There are a little bit of some signs of reaccelerating inflation. This has really just been within the last month or so, and it's mostly coming from consumer spending more and coming from the retail sales data, and that people are still buying even though prices are high. We don't think this is going to be runaway inflation. It just could be a little bit of a blip where we can have inflation come up for just a little bit and then continue to trend downwards. But it's something we're watching closely. Commercial real estate, they're going to face some headwinds as some of this office space. People, I know that we're in an office right now, but a lot of people haven't returned to the office, and those loans are coming due. And these offices, these buildings are going to have to try to roll over these loans, and it could cause some headwinds for the commercial real estate sector, and it could flow over to some banks. It's just something we're watching, and a potential risk for portfolios. When you think about interest and interest rates moving up, the interest expense is growing as a percentage of our federal budget and federal revenue. Borrowing costs are increasing. The government is still spending in deficits and high deficits, and that's not really expected to stop anytime soon. But it's something to be cautious about, and something that we're watching, just generally how our federal government is handling their finances. And then lastly, tensions in the Middle East are escalating. We saw just the headline just over the weekend about the Iran attack, and Israel is expected to retaliate. It's just something we're watching. The geopolitical risks are escalating, especially in the Middle East. So I know that we still have Russia conflict, we have wars just all over the globe, but you can't dodge geopolitical risk, and it's something that we have our eyes on.
Right, and there's also a concept called nearshoring, where maybe we don't do as much trade with China, but maybe we still trade with, say, Mexico or something along those lines. So there's still companies out there that are going to benefit from different trading aspects worldwide. So we don't want to just say, okay, something's happening overseas, maybe we need to, we don't want to bring it all back to the United States. We want to stay diversified. And then also noting, I wanted to note that there is a point that's not on the optimism or point of caution slides here, which is the U.S. election. It's going to happen. It is going to happen one way or another. There's no stopping it. And so, we've seen throughout historical data that it's not necessarily who's in office, it's about what the economy is doing and what is happening in the markets as a reflection of that. So we don't want to put that on a caution or an optimism, but of course that's going to be in the headlines for the next 6 months or so. So another thing that we'll be watching as well. So with that, we thank you for spending some time with us this afternoon, Chad and Franco. Thanks for joining us as well. And we wish everyone a happy rest of the week. Take care.